completely out of line. A very, very substantial amount of hedge value available for long oil traders to come into this as a play. When we look at it from the inflation break-evens, also very bullish. Also very bullish. Hold on a second, that oil is breaking south, guys. Okay, I bought some oil there. I took some oil as it broke the 73.75 on the 11 contract. So if you're trading NOV, I am long oil. Just being touched into that level again, so we'll take that and we'll walk away with a wee bit of profit on that trade. We'll look at maybe going again into that bit of business. So I did some business there at 73.75. It bounced up okay. We got up to 82s. We made some money on it. We scratched out at break evens, and I'm going to be trying to work perhaps a little bit of buy side business here. See if we can capture a little bit of this upside away from this price level. We've got a few $1,000s on the trade now, so that's okay. Stops in at break even again on that trade. I'm going to cancel out some of my liquidity that I've got positioned underneath the market just to see if it brings the price down a little bit. I'd like to run the stops again for a second time so that we can try and get a better value and a better volume. So that's what I'm thinking just now. Looking at the crack spreads, the crack spread obviously poured in behind this trade, but it's still got value divergence in the background. It had been very bullish at this lower print, and obviously that lift there has caused the crack spread to drop. But this crack spread drop suggesting there is some supply coming in from the RBOB markets, and that's obviously one of the concerns. That's why I would rather be buying if I get a little bit extra discount. Not quite the same story on the Brent WTI spreads. You can see the Brent WTI spread still relatively perky on the upside. But obviously this rise in WTI that we've just bought into is obviously giving us some cause for the Brent to reverse, but it's holding on to its gains, and that's okay. That's pretty good news. Looking at commodity risk, we can see there's definitely a lot of sell pressure coming into the commodity risk line, but that's probably a reaction to the fact that the commodity risk line didn't sell off when the oil price sold off. So I think there's probably a few oil copper hedgers in place here. So there's an oil buyer against maybe some copper sellers up here, and it's just caused that to spread into a spread trade at that stage. So I'm watching to see if this changes direction, and that'll obviously help us out with a bit of bottom edge. Looking at the gas markets, we talked about the gas markets earlier on. Remember we told you about selling the gas up here? Does anybody remember that phase? We talked about it live in classroom. You'll remember this, Paul, because you trade gas. So we can see in here, very, very simple. Selling gas on higher prices, good sell off on the gas price, very, very profitable. And it wasn't straight away, but it was certainly exactly what we said was going to happen on the gas in terms of that hedge. And if anybody traded that hedge, of course, you would have been buying oil, selling gas, buying oil, and then obviously the sell on gas made a lot of money. You would have scratched out your oil and you'd have been left with a short gas trade, which has made a fortune, absolute fortune. So well done for anybody that can understand what I'm talking about.